We're seeing the consumption data. We're seeing the manufacturing data. I just think when you factor in the stimulus data in the first half of the year, it's definitely going to be front end loaded, if you will, for 2021. I'd like to see capital investment pick up in the second half. And even if that does, if you're seeing 7% growth in the first quarter, maybe 6% in the second quarter, we may be disappointed with only a 4% pace of growth in the fourth quarter, which kind of characterizes these last couple of years. 4% is still an excellent number, but just a gradual reduction, or as the Beige Book said, accelerating at a modest pace. Will be a little more modest in the second half of this year.
So, Steve, when you take the Beige Book today, you couple it with what's been another tidal wave of a week of Fed speak, including Powell earlier today, is there anything that we've seen or heard that would change the message, not change the message, I think they've been pretty consistent, but would change the market's interpretation of the message from the Fed right now?
I don't think so. And while I'm reading the Beige Book, I'm trying to think about what you can't really know, right? Which is, what would a Beige Book look like after the economy emerged from a pandemic? And it's impossible to know, but you can sort of game it out, right? You would see an economy coming back. You would see robust activity in sectors that were the hardest hit: leisure and hospitality, potentially tourism. All of those were good signs. It would not also be crazy to expect supply disruptions. By the way, Philadelphia calling them severe. Other central banks said they were widespread. Because why is that? Well, the manufacturers are suffering the same kind of problems that retailers and the schools and everybody has. Not everybody's back to work. So the whole global supply chain is not back up. So a lot of this is to be expected. And the reason I'm answering your question this way, Morgan, is that this is the outlook that I believe the Federal Reserve expects. They expect there to be these kind of bottlenecks. They expect there to be pricing pressure in sectors that come back quickly, especially without the labor to provide the services that are demanded by the pickup in demand. You also have a lot of stimulus out there in the economy. So I don't think this changes very much. Powell today in his speech at the Economic Club of Washington was very clear that, look, we're looking for a variety of things to be in place. We want to get people back to work. We want to get inflation above 2%. We're on the road. We're having some inflation now, but I don't think this changes the Fed's outlook. I know they'll be keeping an eye on it, though.
Michelle, the labor piece of this. I mean, we had Domino's, for example, one of a number of CEOs and companies that's been on our air lately. We had Domino's on the show earlier in the week, said it's a quote-unquote tight labor market and that it's competitive trying to hire enough people to come in. When you take some of those types of comments that we're getting from employers right now, particularly employers of people that are maybe on the lower end of the pay spectrum or getting paid on an hourly basis, and then you couple it with what we're seeing in the Beige Book today, what is the takeaway there in terms of the labor market and how tight it actually really is right now?
Well, it's certainly the narrative from today's Beige Book, where there's evidence of labor shortages or difficulty finding labor, particularly for some of the lower skilled, lower income jobs. But I tend to think it will prove to be somewhat temporary.
Transitory?
We know transitory is the word. Yeah. And, we saw a big drop in the labor force participation rate on the back of COVID. We know that a lot of people left the labor market because of concerns over health or concerns, of taking care of children, et cetera. And the hope is that once we get past that, once you're at a level where the economy is considered safe enough, people feel comfortable re-engaging, they will come back in, especially once the impact from stimulus and the social safety net start to fade. So I think going back to Steve's point, when you kind of put it all together and you think about what this means for the Fed, it really is a question of how much of this is transitory versus sticky in the economy. And I think from the Fed's perspective, they're assuming a lot of this is temporary. They want to see how it plays out, and they're not going to adjust monetary policy based off of some of the data or the anecdotes that we're seeing right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.